Hey investor, welcome back to Fiscal Voyage. My name is Felix, and in this video we're going to talk about a company that has potential growth rate of 20% for the next 3 years. For the last 2 years, earnings grew at a rate of 32% in 2018 and 22% last year. But before we start, if you're new to the channel, make sure to hit the subscribe button if you want to be a better investor. Make sure to watch towards the end of the video because I'm going to provide you with a fair value price of the company and give you my recommendation to determine if it's a buy, hold, or sell at current prices. Okay, let's start with analysis on Anthem Inc., ticker symbol ANTM. The company is a health insurance provider in the United States and is the largest for-profit managed healthcare company in the Blue Cross Blue Shield Association. As of 2018, the company had approximately 40 million members, and Anthem is ranked 33rd on the Fortune 500 list. So let's go with the fundamentals. From 2010 to 2019, the company had a modest revenue growth rate of 6.7%, as well as net income came in at 5.8%. So that's it's okay, not attractive, but it's nice growth. The credit rating is good at A, which is investment grade, and earnings, however, in this 10-year period grew at 12.5%. But what makes this company attractive currently is that for the past 5 years, earnings has been growing at a better rate at 17.6%, same thing as net income with a 5-year average growth of 17.1%. Revenue hasn't had that double-digit growth, but it is better than the 10-year average, where the 5-year average is 7.2% compared to the 6.7% for the 10 years. So that's heading in the right direction. So let's continue with the fundamentals. For earnings, the company had 2019 earnings came in at $19.44. Net margin, however, for most distribution insurance company, net margin is very tight. So their net margin came in at 4.6% for 2019, which is, however, expanded versus 2018 net margin of 4.1%. Return on equity at 15.9%. They've been consistent with that, with a 5-year average in that area, so that's good there, consistency. And the current yield, however, it is low at 1.43%. It is much lower than my criteria of about 2.5, 3.0 and higher. I personally like to see it at 3.5 and higher, but because it's low, I find this company still attractive because of the growth rate. The 5-year dividend growth rate is at 12.8%, and the company had a most recent increase at 18.7%. And if later in the presentation, I'll show you guys that earnings is expected to grow at a double-digit rate. So therefore, I think earnings dividend growth is going to grow as well in double-digit rate, which makes it attractive, even though the current yield is only 1.43. And the current yield is slightly higher than the 5-year average of 1.4. So that may be an indicator that it may be fairly valued. But we'll take a look at that later in the presentation. The dividend payout ratio is only 17%. As most cases, when a company has a very low yield, the dividend payout ratio tends to be much low. But this is good because this gives the company plenty room to grow the dividend at a nice rate of the 5-year average of 12% or higher, or the most recent 18.7%. And the company's been growing the dividends for 10 consecutive years. They're fairly new in the dividend growth realm. They just started again 10 years ago, but they've been growing it at a very nice, attractive rate for the past 10 years. They have a charter rule of 14.2, so this beats the criteria of 10, 11 or higher, so that's good there. And for example, the 2019 adjusted earnings of 1944 is 22% higher than 2018 earnings. So we'll look at that here with that future outlook later. So the balance sheet is very good. Debt to cap by only 36%, which is great. The current ratio is better than the norm of 1.5, so this is good here at 1.6. You like to see current ratio of 1.5, which is more assets than liability. However, the debt to equity ratio is fairly high. It's not concerning, 1.6, but just FYI there. And the price to book is a good ratio of 2.11, which, however, it is higher than the 5-year average, but 2.11 price to book is pretty good here. I like to see it 3.0 or less for the price to book ratio. So overall, the balance sheet looks good. Future outlook, here's where it's exciting. 2020 earnings are expected to be $22.35, which is higher than 2019 earnings of $19.44. So even with the lockdown, the economic lockdown, earnings are higher expectedly for 2020. So that's good news there. That shows the resilience and the fortitude of this company to withstand, an economic lockdown. 2021 earnings are expected to be even higher than 2020 at $25.49, so that's great. And CFRA has a 3-year projected earnings growth of 10%. Some other analysts are expecting 13 to 14% growth, but overall you're seeing a low double-digit growth rate, so that's good here. With my dividend drill return model, we get a projected total return of 12.9% annually going forward. So that's very attractive here at today's prices. The 12.9% total return is higher than my 9% criteria, so that's good. Currently, the company has a current PE of 12.8 with a forward PE of 11.9, which is based on 2020 expected earnings. So that's attractive there. I always like to see the current yield or the current PE higher than the forward PE. That means earnings are expected to be higher than the previous year. So that's there. And the most attractive thing here is the 5-year PE average of 16.4 is much higher than the forward PE. So that's very good there. So this is maybe an indicator that the company is undervalued. If we look at the fast graph, the black line again is the monthly closing price. The blue is the normal PE multiple of 13.9, and the orange is a earnings of a 15 multiple. As you can see here, the company looks like it follows both the blue and the orange line, which is about the 15 multiple. So anywhere between 14 and 15 is fairly valued. And as we saw, a PE of 12.7 currently, so that means it's undervalued based on the fast graph. And as you can see, earnings for 2020 is going to be 15% higher than 2019's, and 2021 is expected to be 14% higher than 2020. And then 2022, year 2022 is going to be 12%. So the company is expected to grow earnings at a double-digit rate, so it's very attractive. With a low PE ratio and a adjusted earnings yield of 7.8, that means it's very attractive at current prices. As you can see, the company in 2018 had a tremendous spurt of growth of 32%, and then last year of 22%. So the past few years, earnings have been growing very nicely. And again, earnings are expected to grow at double-digit rate going forward. As you can see, total annual rate of return is projected for 2022 of about 18.7%. So that's very attractive of getting 18% annual rate of return, especially since most of the market is overvalued. But here we find a company that looks to be undervalued and very attractive at current prices. So let's look at the fair value price. As you can see, CFRA has a fair price of $303.97. Morningstar at $348. Fast graph, as we just saw, which is based on 2020 earnings with a 15 multiple, which is $312.48. Yahoo came in at $335, and my dividend discount model analysis at $216.60. This was low because of the really low yield, but because I'm projecting a 10-year 10% next 3 years growth rate for the dividend, plus an 8% after that with a discount rate of 10, we came up with 216. That's much lower than the current prices, but I was conservative with the 3 year because I think they're going to be growing dividends in the mid-teens because of the high growth rate as well as the very low payout ratio. So we'll see how it goes from here. But if we average out the 5, we get a fair price of $303.26. And currently the company goes for $265.25, meaning it is undervalued by 14.3%. So that's very attractive. It meets my criteria of 10% safety and margin, and it's a very solid company. That's why I have a buy recommendation for Anthem. So as you just saw, I have a buy recommendation for Anthem Inc. The most attractive part of this company right now is the valuation is fairly low, it's undervalued as you just saw, as well as the future growth prospect for this company. Growth prospect as well as that low payout ratio will equal high dividend growth rate for the foreseeable future. A few things that I don't like is the low current yield, as well as the debt to equity ratio is fairly high, but it's still manageable. So overall, the company is very solid. And as I mentioned, different analysts are expecting anywhere from 12 to 14% of earnings growth for the next 2 to 3 years. So you combine that growth rate with a low PE and a very attractive dividend growth rate, you have some real nice potential return. Again, if this is the first time visiting my channel, make sure to hit that subscribe button, and I'll see you guys on the next video, and stay safe.